The end of 2020 is proving a particularly traumatic time for the US. COVID-19 new cases are averaging 200,000 per day, more than 100,000 citizens are battling the virus in hospital, and over 2,000 people are dying each day. In response, restrictions on domestic trade have been increased coast to coast to reduce the virus's spread. Despite these developments, the federal government continues to drag its feet in providing additional support. The continued absence of fiscal stimulus notwithstanding, December has heralded the beginning of the return of confidence in the US's medium-term outlook. The Electoral College has confirmed Joe Biden as president-elect. Vaccinations against COVID-19 have begun for medical personnel across the country, and the FOMC has made clear they will continue to provide extraordinary support for the economy as long as necessary. Previously, the FOMC had only made a commitment to extend asset purchases over coming months. Now, monthly Treasury purchases of $80 billion and mortgage-backed security purchases of $40 billion are set to continue until substantial further progress has been made towards maximum employment and inflation of 2%. Based on their updated forecasts, this could take a long time. While their view on GDP has been materially revised up for 2020, the 2021 to 2023 forecasts have only been edged higher, highlighting elevated uncertainty. The unemployment rate is consequently still expected to remain above its pre-pandemic level, our best benchmark for maximum employment, through to the end of 2023. Inflation also only gets back to 2% at the end of the forecast period, and risk for inflation remains skewed to the downside. Essentially then, the FOMC's December guidance is a conditional but open-ended commitment to quantitative easing. To be clear, the activity gains anticipated by the FOMC and Westpac over the forecast period are substantial. The next few years will see strong above-trend growth across their economy and the world more broadly, led by the consumer. However, the cost of the pandemic was so significant and subpar inflation is so entrenched that these gains are highly unlikely to trigger policy normalisation in the foreseeable future. In 2021 then, the global growth and policy environment will remain highly supportive of real and financial assets. Specifically, in the US and globally, medium and long-term interest rates are expected to hold to the lower end of pre-pandemic ranges, buoying house prices. Falling rates of unemployment and the opening up of economies via vaccination programs will also give US and global business revenue a significant boost. Together with historically low interest rates, these factors should produce a favourable environment for equities and risk appetite more broadly. This brings us back to currency markets. In our end-of-year market outlook publication, we highlighted that the confluence of factors we saw globally in 2021, including policy support and growth prospects, favoured a further robust rally in risk-positive currencies such as the Australian dollar, at the expense of safe havens such as the US dollar. The FOMC's perspective at December franks our expectation for a near 5% fall in the US dollar on a DXY basis to mid-2022. The consequence for the Australian dollar being a rise to 80 cents at the end of 2021 and 82 cents in early 2022. As a final point, it is worth emphasising that we continue to view US fiscal policy as unlikely to halt the US dollar's downtrend. Post-January's inauguration, incoming President Joe Biden will make clear his agenda. However, given current circumstances and a divided Congress, large-scale fiscal spending on infrastructure is unlikely to be top of that list. Instead, if successful, gains for US productivity and growth from investment initiatives are likely to be seen mid to late 2022. Also, any effect on currency markets could be neutralised by global investment momentum at that time, particularly in Asia where long-term public and private investment have strong support. We'll see you in 2021.